So let's talk about some case studies for tokenizing real estate. First of all, I'll give a quick intro on myself. My name is Henry Elder. I am the president of the International Blockchain Real Estate Association and the head of real estate at Digital Asset Advisors. My background, I've actually been in LA real estate for most of my professional life. My family's been in LA real estate for 4 generations, so I never really had a choice to do anything different. I just decided to go a little bit more of a tech route. Did some real estate, investment banking, and private equity. Realized pretty quickly that the method of doing business in real estate was pretty much exactly the same as how my great-grandfather had been doing it 100 years ago. And the rate of investment into the space was increasing at an incredible clip and for tech innovation. But I was not going to be a part of that, sitting behind a desk at Latitude Real Estate Investors, which is where I was. So I started researching the blockchain. I received my first Bitcoin for my birthday in 2016. And in 2017, I started looking at how I could raise a private equity fund using these new capital markets, and quickly realized that these were securities that were being sold. I actually ran into Brock Pierce at an event in Venice, and he was talking about how, yeah, it's perfectly simple to issue these under a crowdfunding regulation, a crowdfunding exemption. I was like, okay, but how? He was like, just figure it out. I was like, oh my God. And so spent a whole bunch of time researching that, put a team together, wrote a white paper, but realized pretty quickly in 2017 that there was absolutely no way that there was enough demand for security tokens to raise enough money to raise a fund. At that time, there had only been 3 security token offerings, and they were anywhere from 10 to $15 million is how much they had raised, which in an individual fund is not really economically feasible. So we started looking at, all right, what can you do that will create some sort of a financial instrument that's in that, $10 to $15 million range? And what we said was, all right, LP equity interests in commercial real estate. And so we synced up with a team out of New York called Slice, out of Israel called Slice, and we teamed up with a developer in New York called HAP, and we tokenized a $5 million LP position in one of their commercial properties almost exactly a year ago, a little more than a year ago. So let me take you through sort of the history of tokenization and how we got to this, right? So we started out with ICOs, which are famous for being bastions of fraud, right? We had BitConnect, we had these ICO rating companies that really didn't do anything in terms of giving us some good guidelines for investing. But out of that, we got the first real estate ICOs, which was ReDAO was one of the first, Atlant, some of you may remember. Neither one of them really took off. Both of them were taking that sort of unregulated ICO route. Both of them were not in the US. Atlant, I think, was out of Russia, and ReDAO was out of Malaysia. But it laid the groundwork for innovation in the real estate space using blockchain. And so we had companies like Velox.re and Propi that were looking at other ways to use the blockchain, not necessarily tokenizing real estate, but taking the blockchain and putting title on it, or taking individual real estate listings and making it easier for people to transact and buy them from an offshore domicile using cryptocurrency, which is what Propi was doing. In the meantime, in early 2017, like I said, there were a couple STOs, right? We had Blockchain Capital was the first, which was Brock Pierce's group. They did a $10 million raise. Spice VC was also that year, Spice VC was in early 2018. And what happened out of this is people said, all right, this unregulated space is not necessarily right for ICOs, for real estate, because real estate is a easily regulated asset, right? A lot of ICOs sort of thrived because it was very difficult to shut down the teams, right? They were these decentralized teams, and the actual assets that they owned were oftentimes on the blockchain, so it wasn't something that regulators could swoop in and secure. But real estate, if real estate is securitized in a manner that is non-compliant or illegal, it's really quite easy for a court or a regulator to take ownership of that real estate away from this illegal scheme, right? And so I think that that's a lot of what made it very difficult for ReDAO and Atlant to succeed. But at the same time, in the US, where we have where we had a much stricter focus on this sort of compliance, we saw companies like Slice, companies like Harbor, Elevated Returns, and did the St. Regis pop up because they had sort of been working a little bit more quietly, right? At Slice, we had a million people sort of beating down our door saying, do an ICO, do an ICO, do an ICO. We're like, no, we're just going to build this tech. We're going to find a partner. We're going to do this completely compliantly. And we probably missed out on being able to raise like $20 million by not doing an ICO. But it was the better path to do it. And so in 2018 and throughout 2018, we saw a whole bunch of companies pop up in the US looking at ways to do this compliantly. So what is the point of real estate tokenization, right? I'm sure that you guys have touched on the benefits that tokenization brings to traditional securities, the fact that it's basically this complex dance between broker-dealers, the DTCC, transfer agents, clearinghouses, all of these different pieces that are sort of plugged in together. And I just took and passed my Series 7 examination on Friday, which was a real tough test. I actually took all three of the tests. I took the SIE, the Series 63, and the Series 7 in less than 30 days. Just like pounded through all of them, which is probably why I'm sick now. But so this stuff is like all like just running around in my head. It's incredible, the kinds of laws and manual compliance that has to be enacted in order to make sure that, for instance, somebody doesn't sell short a particular stock without actually having borrowed it from someone before, right? That's like inconceivable on the blockchain, but in the existing capital markets, because everything is basically running 2 days ahead of actual settlement, someone can easily sell short a stock without actually having borrowed it from anyone. And so there are specific laws to make sure that that doesn't happen, right? In the blockchain, all of that would be automated. That would never, ever occur. And you don't have to have 5 different parties making sure that it's happening right. It just automatically happens. Real estate is even worse than public securities. Real estate is one of the most manual processes in existence, right? Down to the actual closing of the acquisition of any property, where you literally have to go stand in line at the recorder's office and have them stamp a piece of paper, and if you're not in that line by 8 a.m., then you have to push the closing to the next day, right? That's crazy, absolutely crazy, but that's how real estate works. So with real estate tokenization, you can basically switch from all of these manual processes to a more automated process, right? The cap tables in real estate, typically, it's literally, hopefully, just an Excel spreadsheet, right? Or people sometimes don't even put it in an Excel spreadsheet. They just put together an operating agreement, and you have to go back and reference the operating agreement every time you're trying to figure out how many people own, what percentage of it, because it's just written there on a non-readable PDF that just lives on someone's computer somewhere. So you can move that onto the blockchain, right? It's totally legal in California, it's legal in Delaware, it's legal in Nevada, in Wyoming, in several other states as well now. And that allows you to build in all kinds of automation. I'll get a little bit more into the details of that a little bit later. Compliance factors into that as well. International investment, a particularly interesting use case, and one of the first ones for blockchain, right, was can we figure out how to use Bitcoin for remittances? Well, if blockchain is useful for transferring money across borders, then it's also incredibly useful for transferring ownership stakes, right, across borders in a more compliant and more automated manner. Creating liquidity is probably the biggest one that everybody talks about, and something that we're still trying to build out, because the problem with liquidity is that it's not binary, right? You don't just flip a switch and there is liquidity. We're still trying to, with Open Finance Network, with T0, with the other companies that are coming online, we're trying to create these order books and create these pools of liquidity so that you can go in and say, hey, I have a 10% interest in Sears Tower and I would like to sell it, who wants to buy it? Whereas right now, basically all that you can do is go to these large secondary market buyers that will force you to take a 20% haircut because they're basically the only people who will move into those otherwise illiquid positions. With these sort of automation that you can program into these digital smart securities, now you can create these venues for people to trade and you don't have to have any sort of manual checks. The GP, the general partners, and also I sometimes run really far ahead of myself. So if you guys have any questions about any of this, especially since it's in a group, and I'm saying a term that you guys haven't covered before or you don't understand or whatever, feel free to just tell me. But so a lot of the reason that there's not a ton of liquidity in real estate cap stacks is because the GP, the general partner, retains almost all of the liability, and the lender also has significant liabilities under the Patriot Act for KYC and AML. And so they basically are not willing to make it easy for LPs to trade in and out of positions without the confidence that the compliance will be enacted and that their liability will be protected. So, and then unlocking new structures, I'll talk a little bit about more about that later. Propeller, which is now called Fluidity Factora out of New York, doing some really interesting things with how they're structuring these securities. So let's talk about one of the first ones, Slice. I was on this project, and the deal that we did was called Slice Manhattan 1. It was in New York, ground-up development at 215 West 28th Street. It was a $380 million mixed-use, mainly apartments, and there's a retail on the ground floor development. Built by a company called HAP, who we partnered with. Really interesting group, and they were very lucky that we found them because they were both patient and they were innovative. So they were willing to take this, take the risk of going this new path, and then they were very patient with us, but it took us a long time to actually raise some money for them. And so, being one of the first ones, there wasn't really a securitized. There wasn't a security, there wasn't a tokeny, there wasn't a polymath. I think Securitize actually was around at this time, but they had a pretty bad reputation. Securitize, they came out of Spice VC and the process that Spice VC took to tokenize their VC raise, and Securitize really sort of iterated into the incredible powerhouse that they are today. I have a ton of respect for those guys. They've accomplished a lot, but this was early days, right? And they were still iterating, and they were making mistakes. And so we were sort of like, oh, should we go with Securitize? And then, we talked to some people, and some people were like, I don't know if you want to work with them yet, which I think it's great that they did it the way that they did it, because it put them in the right position to basically be the 800-pound gorilla in the space today, which I think is fantastic. But so what that meant, since there weren't really any third-party providers of tokenization services, we had to just build it ourselves. And so we built it on the Stellar network. And that was an interesting process, mainly because what we found out was that it's not really that difficult to tokenize. A lot of the value in these third-party providers is really more in the compliance side of it. But for someone like us, we were doing a Reg D issuance. Actually, we were doing a Reg S. But the kinds of restrictions that we had to build into the security tokens we're running on Stellar were not that complex in order to be compliant. And since we were building in a lockup anyways, we were going to have everything be locked up for 12 months, which is pretty much industry standard right now because of Reg D. There wasn't a ton of pressure on us to focus on compliance, on the compliance side of it, right? We could basically create the token, we could sell the token, and since it wasn't going to move from anyone's account for at least 12 months, we didn't have to focus so much on the compliance side of it first. We could just get the tokenization side done. So we did that, and excuse me. What we had to figure out from there, since we were doing primarily a Reg S, was how do we distribute these tokens internationally? How do we find the investors, and then how do we get the tokens to them? That was probably one of the most difficult things that we had to face at the time. This was March, April, May of 2018. The ICO markets were still going strong, but we're sort of in the process of imploding, right? The SEC had issued a whole bunch of subpoenas, and more institutional type investors were very wary of this space. And so in this environment, we were trying to introduce these two very different industries. The cryptocurrency and blockchain industry, which is very much the, move fast, break things, forget the regulators, we're going to create a new financial paradigm, and the real estate industry, which is incredibly conservative, slow moving, dominated by, people who still, calculate things on the back of a napkin. And so we learned a lot of lessons. We actually ended up spinning down Slice at the end of last year because what we found was that the processes that we were trying to commercialize were not economically feasible at the time. There was too much education, there was too much reluctance that still needed to be overcome before you could really create a platform where you were just pumping these things out. And so the lessons that we learned were that we were very early, right? I mean, we should have known that from the beginning, but we had this conception that there was going to be this wave of cryptocurrency investors that were going to come flowing into these things because they were sick of the volatility in cryptocurrency prices and they wanted to protect their gains in something solid like real estate. But what we didn't realize was that cryptocurrency investors at the time were pretty much divided into two groups, right? One were the religiously anti-establishment, like the people who had been in it since 2010, since 2013, and who really saw it as a new financial paradigm that was being created without regulators, without having to comply with the existing regulatory schemes that they sort of saw as this unfair system that had been created by the elites, right? And for those people, our compliant, real estate security token solution was like, it was the antithesis of everything that they stood for. So they were not interested in investing in this at the time. And then the other faction of cryptocurrency investors were people who had started investing in 2017, had seen 10,000x gains, had started the year with $10,000 and ended it with $1 million, and now that had crashed down to 500,000 or 300,000, and all of them believed that it was going to come back tomorrow, and that by trading out of it, they were actually locking in their losses. And so none of those people wanted to invest in real estate security tokens. So we transitioned, and we said, all right, then we're going to focus on real estate investors, because this is a far better way to invest in real estate than the ways that they had been investing previously. And what we found there was that there was this huge educational hurdle that we had to overcome. These people, when we said, hey, we're going to do this, there's going to be liquidity. They were like, how are you going to give us liquidity? And we were like, it's going to be on the blockchain, right? And they were like, what's the blockchain? And we were like, well, have you heard of Bitcoin? And it was like, as soon as we went down that path, they just shut off. They didn't want to hear about it anymore because they associated Bitcoin and cryptocurrencies with ICOs, with fraud, with money laundering, with human trafficking, with terrorists, with the Silk Road, all of that stuff. And so it took too long and it was too difficult to close capital investments in the deal for us to figure out a way to commercialize that process. And then the last one was that we realized that a lot of the benefits here were really predicated upon the liquidity argument. And the problem is that there is no liquidity right now. And back then, there's very little liquidity right now. And back then, there was zero liquidity whatsoever, right? And so when you're selling something and you're saying, hey, it's going to be liquid, but it's not liquid now, but if this takes off, it will be liquid in the future, it's just not a very strong value proposition that you can draw for the investor to say, this is why you should invest in this right now. And for real estate investors who, like I said, are very conservative and slow moving, it just wasn't enough for them to jump into this new space. So there were several more deals after we did Slice. I'm going to talk about Propeller, I'm going to talk about the Harvard deal, and I'm going to talk about Invenium, which is happening this year. I'm not going to talk about the St. Regis because I did a 2-hour webinar kind of case study on that, which you can actually find online with the Security Token Academy, and that can just go into way more detail. We had this pretty awesome thing where we sat in the STA like recording studio, and we had the elevated returns guys call in from a studio in Chicago, and then we had their lawyers call in from a studio in New York, and we basically talked to all of them for 2 hours and did the whole, in-depth case study. So if you guys want to, learn about that, I would say just go watch that video.
The St. Regis investment.
Yeah, the St. Regis investment. Yeah. So Propeller did a really cool deal. Propeller is, their deal was called 13 East Plus West. It was a condo deal in Brooklyn. Propeller is run by a guy named Todd Livian. Todd's background is in computer science. So he was fascinated by this whole blockchain thing. He called me in April of 2018. I took him through everything we were doing with Slice. He was like, this is really cool. I want to tokenize something. But April and May is when we were really like just hitting a wall with investors. And I was like, look, dude, I don't think you really want to tokenize something right now because there's not really a market to sell it into, but I'll let you know when, it's ready. What I didn't realize is that Todd's super driven. He was super dedicated to this. He didn't want to wait. So he went ahead and started tokenizing stuff anyways. His company, Propeller, is a broker-dealer. And they're the broker-dealer behind several real estate private equity funds that already existed. They've been in existence for several years. So the guy was a real estate OG, right? He knew how to make this stuff happen. And more importantly, he had a broker-dealer, so he had distribution. He had access directly to LPs that he already knew were willing to invest, and those LPs already trusted him to bring good deals to them. So what they did is they took both the equity and the debt on this condo project. They tokenized both positions, and they wrote something called the two-token waterfall, which is a really fascinating white paper on innovative ways that you can restructure the real estate capital stack in a tokenized format. Basically separating out all the different pieces of both the debt and the equity pieces, preferred returns, equity hurdles, waterfalls, the senior secured status of the debt, and separate it out from different pieces and sort of mix it into other parts of the cap stack and create new tranches. Really interesting white paper that created a lot of buzz at the end of last year when they wrote it, but they basically put it into effect on 13 East Plus West in both the equity and the debt tranches. And they laid off the debt, and I'm pretty sure they laid off the equity as well, fairly quickly. It was very successful. And a lot of that was because, Todd basically had this captive investor base. He already had this pool, this syndicate of LPs who trusted him to bring them the right product. So he solved a huge issue that we had with Slice, which was that we were basically a bunch of late 20s to early 30s something entrepreneurs who were running around the world, talking to investors we had never met before and trying to convince them to jump into this new asset class and trust us. Whereas Todd already had the trust, Propeller already had the trust. And so when he sat down and talked to these LPs, these were people that had already done tens or hundreds of millions of dollars worth of deals with him. And so for him, that educational hurdle, that trust hurdle, was much lower for him to accomplish. And so a couple lessons, to kind of pull from this is that while the market was not necessarily fully mature yet, there were certain participants who had the necessary experience and trust equity that they could get deals like this done. And so Propeller, Todd, they did a ton to sort of move the space forward. I'm super thankful to them. Todd's a good friend. I'm actually going to be he's hosting a Fluidity Summit in New York on the 9th, on Thursday, this week.
With Bill Tide?
I don't remember. Yeah.
The Matrix is going to be the thing.
Oh, really?
Yeah.
Oh, that's awesome. So they're going to have this Fluidity Summit in New York on Thursday. I think I'm going to fly out there and be at that. So a really cool deal. I would definitely suggest that you guys go out and look up the two-token waterfall. The company is no longer called Propeller. They're now called Fluidity Factora. They sort of teamed up with AirSwap which is a really interesting decentralized exchange, so that they can get their tokens trading on this decentralized exchange. So Harbor, this deal was in the news recently. This was like kind of like the next big one. You know, Slice, we did Slice, and then there was the St. Regis, and then Harbor was the next big one that was announced. Harbor was announced near the end of November, sort of the opposite of everything that Todd did right. Harbor kind of did wrong. Harbor, their deal was the hub at Columbia. It was a student housing deal in the Carolinas. Very interesting deal that my dad had actually sold previously, like 10 years previously, been the broker on the sale for this property. And so, excuse me, Harbor was a tech company, right? Where Propeller was a broker-dealer, Harbor was a tech company. They came at this from a very tech-focused point of view. They're VC-backed. The guy who runs it, Josh Stein, brilliant, but he's a federal prosecutor. He's a former federal prosecutor. He's not a capital markets guy. Most of the team was very tech-focused. And so they came at this with the idea that, okay, blockchain's going to change everything, come buy these tokens. They set the price, and they said, come buy these things. And they partnered with this broker-dealer that didn't really have any experience with real estate and didn't have any experience with tokens. And so what ended up happening is the deal sort of fell on its face, and they actually officially killed it a couple weeks ago, but it was really sort of a dead man walking several months ago. Nobody was really investing in it. The ultimate cause of death publicly is that the lender pulled out, which is another risk factor that I'll discuss a little bit later. But I think one of the biggest things that I learned from this is that we had been, everybody who had been operating in this space had been coming at it from this perspective that tokens were innovative and tokens were what people wanted. And ultimately, tokens ended up being a barrier. And Propeller, another reason that I think that they succeeded is that the prospectus for the deal, the website for the deal, Propeller themselves, they were very deal focused. It was all about the deal. And then there was one section in the offering memorandum that said, oh, by the way, if you want to take delivery of your interest in tokens, you can, but we're not forcing you to, right? Whereas when you went to the website for this deal, it was more like blockchain, 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 tokens, 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 which is a mistake that we made with Slice as well. But we made that mistake with Slice in May. Propeller made that same mistake 6 or 7 months later. And the biggest thing that I think it showed was that as far as the tokens go, it's just another educational hurdle that you have to overcome. And so you can tokenize you can tokenize a project and have people access it through tokens, but really the best way to do it is just have a disclosure in your offering agreement that says, this project can be tokenized in the future, and you can take delivery of your interests in tokens in the future if you want. But there's actually no reason that you need to go through a Securitize, a Securrency, one of those guys, and tokenize it first. Because most of these are using a Regulation D offering exemption, right? And under Reg D, you can't sell your interests. Overall generalization, you can't sell your interest within 12 months, right? You're basically locked into the deal for 12 months, which is fine for now. But that means that if the benefit of a token is liquidity and being able to transfer your interests using that token, then you don't need the token for the first 12 months. There's absolutely no reason for you to create that additional barrier, that additional gate that your investors have to go through by taking delivery of a token. And Harbor, I don't think, realized that early enough. And the other problem was that they set the terms of the deal. They basically said, this is the deal, it's not changing, buy the tokens if you want to buy into the deal. And they thought that there would be so much interest around the blockchain component of it that people would just buy them. But ultimately, the terms of the deal weren't market. And so real estate investors weren't really interested in them. And then what ended up happening at the very end was apparently the lender said, I don't want to deal with a tokenized cap stack. I don't understand my risk and my liability, so I don't approve of this. And people have a tendency to disregard the debt, right? Because your lender is typically a fairly silent partner in your deal, but a lender actually really controls the cap stack. If the lender says no, you're screwed. I mean, that's it. That's the end. And especially when it comes to how you're structuring your equity piece, I mean, your lender basically has veto rights over anything that comprises more than 20% of your equity. And this comprised 50% of the equity. And so the lender said no. And so a couple other lessons, first of all, the pre-selling, they didn't pre-sell it at all. They just basically said, hey, it's available for sale now, please buy it. The team wasn't that great, right? The broker-dealer that they used, not experienced with crypto, not experienced with blockchain, not experienced with real estate. And the timing was also awful. They literally announced it, I think it was right after Thanksgiving, which I don't know if any of you are in the real estate industry, but Thanksgiving to New Year's is a dead period. Deals don't get done during that time. You either are racing to finish deals that you started in November before Thanksgiving, but nobody starts a deal after Thanksgiving. It just doesn't happen. And it gets, buried basically in all of the holiday stuff. So this deal fell apart, unfortunately. Another thing that I think is important to learn from this is that we realize that investors are not attracted by the simple allure and hype of blockchain. There needs to be something immediately innovative that attracts them to it. And that's why I think that this Invenium deal is probably indicative of sort of a next generation of tokenization. Invenium, very interesting deal. They're tokenizing $260 million worth of assets across 4 different assets. One is a single tenant WeWork office building in Miami. I think it's in the Brickell district, which is a great area of Miami. The other one is basically a corporate bond to a real estate developer on the west coast of Florida that has, I think, like 75,000 acres of land that they want to develop. And then a North Dakota student housing project and a back in the water pipeline. Very interesting assets, right? Sort of weird, other than the WeWork Miami. But the good thing is that Invenium has incredible experience capitalizing weird assets. The guy who runs it, Pat O'Meara, I don't know where he came from, there's no P in there. Pat O'Meara, also a friend of mine, really, really interesting dude, who was actually the largest financier for the Catholic Church in the world for a long time. So this is sort of like his bread and butter. He loves strange assets and getting them capitalized, doing this for decades. So sort of like Propeller, he has that trust equity built up where, if he takes a deal to his investors and says invest in this, by the way, there's also this interesting tokenized component of it, they will trust it. So I think these deals will get done. But the innovative side of it, right? What's the innovative side of it? So they have focused on the data-rich potential of the blockchain. So let's think back to 2008, right? 2008, 2009, right? The entire world financial system blows up. And why does it blow up? It blows up because we've created these incredibly complex financial instruments where we're taking mortgages, we're packaging them, we're selling off the packaged instruments, we're selling insurance against the failure of that instrument, we're taking the insurance, we're packaging it, we're selling that off in a packaged instrument, right? And then we're taking all of the different tranches of this, packaging them together and selling those off in packaged instruments. And at the end of the day, you had people that were owning securities but they could not trace through that insanely complex line of packaging to figure out what assets were actually underlying these securities. And the only way that they could do it, if they were so inclined, was finding literal books, right? And going through those books and trying to trace it from this book to that book to this book to that book. And then you have to find out how the actual asset is operating itself, right? Where do you find that data? Well, in a blockchain-based architecture, that should not be an issue, right? You should be able to pull up your token and be able to click through and see, all right, these are exactly what assets are underlying this package security. And this is the rating of each of them. And then click through and say, all right, this is how the asset is actually performing, right? If you are tokenizing something, you should have some sort of a disclaimer or disclosure or a waiver in there that says, all right, if you are using my tokenization platform to sell your securities, then you need to deposit your quarterly operating statements into this system. And then that system is going to broadcast that data to the security holders. Because one of the issues is that after the initial issuance of any sort of a security, the data gets stale after that, right? Especially for a private security where you don't have regular disclosures. It's like if something, if a real estate property sold 3 years ago, and then somebody's trying to buy it 3 years later, they basically have, what's happened in the most recently, but it's very difficult for them to see. I've gotten ahead of myself. Let me back up. So basically, you issue something, right? And you say, all right, here's the operating fundamentals, here are the statements, and then someone's trying to trade a security that's based off of that. Unless you have built the architecture to have that data constantly updating, under these sort of private security issuance exemptions, there's no way for you to get access to the real-time operating data of the security. So let's say that you're trying to buy a tokenized security 2 years later for a property that was tokenized 2 years previously. Really the only thing that you would be able to find, if you can even find it, is the operating statements for 2 years ago. And so this sort of an architecture that Invenium is building out is exactly what we need to create an actual immediate benefit to the holders of those tokenized securities. And the thing is, data reduces risk, right? Data allows you to, it doesn't necessarily reduce it, but it allows you to price risk more perfectly. And so, theoretically, a buyer of a tokenized security would be willing to pay more if that security offers him more data than something comparable, right? Because then he can price his risk better. And with modern portfolio theory, we know that the goal of investing is not necessarily to reduce risk, but is to make sure that you're being paid properly for that risk. And in order to do that, you need the most data that you can possibly get on the underlying securities. And so, this is something that can be done with the blockchain far more efficiently and effectively than it can with current existing manual private placement processes. Wow, say that 3 times fast. And so that's something that Invenium is building, very, very interesting. They're also using an auction format for these securities. So instead of like the Harbor, where they did, all right, here's the price, here's your yield, buy them. Invenium is saying, all right, here's the yield from the asset. We'll do a Dutch auction. You bid whatever you would be willing to buy this yield for. So now you're offering the market the opportunity to price these things. So much more likely that people will actually bid on them, right? And so you're actually creating a market now. Because everybody's going to say, all right, well, they'll underwrite it the way that they will, and they'll say, all right, this is what I'll bid, and they'll put in a bid, because why not? There's nothing for them to lose. Whereas with Harbor, it's like they underwrite it, and they're like, oh, I have to buy this at par, it's only giving me a 5% yield, I'm not willing, that's not something, I don't think it's worth that. Whereas here, they're going to say, all right, it's a 5% yield, maybe I'll pay $98, 98 cents on the dollar, right? They can price that yield however they think is necessary for them to get paid for taking that risk. So super bullish about Invenium. The data part of it, I think, will unlock, I already said the next generation, but maybe the next generation of where this goes. Because right now we're having an explosion of applications for machine learning. And the benefits of machine learning are basically applicable anywhere that you have massive data sets. And real estate is one of the biggest data sets in the world, but traditionally has been very siloed, right? You sort of have to get access to CoStar or Reese or one of these groups, and it's super expensive, and they don't have any sort of a relationship with Yardi and RealPage, which are like the property management software. So a lot of the times the data that's in CoStar or Reese is incorrect. There's really no way to correct for that. But if you can start generating data at the property level that's flowing up through these new data pipelines, then you can start plugging that into machine learning, and you have a much better, you have a much higher confidence in the underlying data because it's coming from the actual securities issuers themselves. And so then you can start plugging that into machine learning algorithms and start deriving insights from that data that you otherwise never would have been able to. So I think that that is absolutely fascinating. We're not really seeing any of this yet, but I think that over the next 5 years, that's actually probably going to be the most valuable use case for all of this. All of this. There's going to be more value being derived from the insights that people are pulling out of these massive data sets that no one ever saw before. So I think that's going to be super fascinating. There's one more thing I wanted to talk about here, but it's sorry. So where do we go from here? I would like to see some multi-asset vehicles get tokenized. I'd like to see a big REIT move, maybe a portion of their assets into some sort of a tokenized vehicle, whether or not it's also a REIT or whether it's the individual underlying properties. I've actually been involved in some talks with some very large REITs around this sort of idea, because most REITs right now are trading at a discount to net asset value. And so we've been looking at tokenization as a way for them to potentially sell minority interests. Excuse me. I should have brought some water. But to sell some minority interest in the underlying assets, retain majority control of those, but see if they can close the gap between the share price and NAV. Tokenization of title. This is pretty fascinating, right? Are you guys familiar with 1031 exchanges? Yeah, are you as well? So 1031 exchange basically says that you can trade like-kind assets. It's actually been restricted specifically to real estate now with the most recent tax reform. So basically you can trade the ownership of one real estate asset for the ownership of another real estate asset, and you can defer all of the capital gains taxes. Amazing wealth creation and wealth preservation tool. Because you can keep doing this. You can keep 1031ing one interest into another asset for your entire life, and then you die, and your children inherit it at a stepped-up basis, and all of that capital gains liability is wiped out. I mean, it's insane, right? It's the reason that my family's been in real estate for 4 generations. But it's not something that's currently applicable to tokenized securities, because securities are not 1031 eligible. Only direct ownership interests in real estate. So that is a tenant in common, a Delaware statutory trust, or a single asset, a single owner with a single asset. And so what we need to see is either the tokenization of title or the tokenization of tenants in common or TICs or DSTs. And so that will be really, really interesting, because if we can open up 1031 exchanges to retail investors, that is true democratization. A lot of people sort of pay lip service to this idea of democratizing access to real estate. Frankly, I think it's a bunch of BS until we start getting 1031s democratized, because right now it's really just, it's the purview of wealthy real estate investors. Tokenization of identity. This is one that will create, I think, incredible efficiencies, because right now, identity, KYC, AML, is still a very manual process. I mean, you can go to Verify Investor, punch some stuff in, it tells you whether it's okay or not, but getting that information from the borrower so that you can go and do those things is super manual. It's a pain in the ass. They're literally sending me PDFs or faxing me documents that say, here's my, oh, thank you so much. Here's my social security number, here's my bank statements, blah, 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 blah. All of that is just incredibly high risk, right? I mean, I literally, in all of my previous, real estate jobs, I had tons of documents lying all over various computers in Google Drive, in Dropbox, that had people's very personal, very important identity data. That's a huge risk, right? But it's also super manual because it goes stale every 6 to 9 months. And so if we can start to tokenize that and create a way for people to say, all right, I'm not sending you the data, I'm sending you, the token, and the token is encrypted, and it's the underlying, there are APIs that are basically linking between the tokenization, the identity tokenization provider, and the bank, and Social Security, and LexisNexis, and TransUnion, and all those guys. And so it's constantly updating, and they can just send you the token, and you can just see, all right, boom, this is what's up. I think that will create some incredible efficiencies. The secondary market thing, so that we can stop saying there will be liquidity, and we can say there is liquidity. Open Finance Network, they're doing a really good job getting themselves out there, getting assets listed, and trying to get people onto the exchanges. And so for like an immediate action item for you guys and anyone else that I talk to, I always say, go to Open Finance Network, go to T0, sign up, right? You don't have to be an accredited investor to buy these things in the secondary markets. Once a Reg D issuance, if you do a Reg D issuance 506C, 506B, you can only sell the primary issuance to accredited investors. But after that 12-month lockup wears off, those accredited investors can sell it to unaccredited investors. So on OFN, on T0, whether you're accredited or not, you can go and you can sign up, and you can start trading in securities where that 12-month lockup has burned off. NYSE has backed, which is a digital assets startup. I can't figure out what exactly they're doing, but they just bought the Digital Asset Clearing Corporation, which is basically a clearinghouse for blockchain-based securities. NASDAQ, super interested in all this stuff. Their trading engine actually powers several cryptocurrency exchanges, so they're very familiar with how these things trade and how to build software around it. And then T0, they just keep moving ahead with whatever they're doing. Basically the same as OFN. And then efficiency versus disintermediation. This is an interesting one, right? Because as these efficiencies are created, a lot of market participants who hide in the shadow of inefficiency, think of like a mediocre real estate broker who's been doing the same job for 30 years, isn't very good at it, but just sort of gets by because the market's inefficient. Those people are probably not going to continue having a job. But real estate brokers as a whole probably are not going to be disintermediated. I think we'll still have a use for them. I think they'll still have a job. If anything, I think that the guys who are at the opposite end of the spectrum from those mediocre brokers, the guys who are powerhouses, are just going to become even more powerhouses, because the efficiencies that this adds will allow them to take on more deals. So I think those guys are going to crush it. So I don't necessarily believe in the total disintermediation that blockchain, a lot of people say that blockchain will bring. I think there's still going to be intermediaries. I think there are going to be new intermediaries that we don't have right now. But I do think it's going to add a lot of efficiencies, and the people who will be disintermediated are the people who, just aren't very good at their jobs. So that's it. Any questions?